Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
If you want a friend in Washington, get a dog. Harry S. Truman. I am prepared to meet my maker. Whether my maker is prepared for the ordeal of meeting me is another matter. Winston Churchill. An appeaser is one who feeds a crocodile, hoping it will eat him last. Forecasts may tell you a great deal about the forecaster, they tell you nothing about the future. Warren Buffett. Money can't buy happiness, but it can buy a yacht big enough to pull up right alongside it.
Wall Street just handed Indian IT a rather expensive memo. Accenture shares plunged nearly 18% after the consulting giant lowered its FY26 growth outlook, citing slower client spending, longer approval cycles, and increased scrutiny of government contracts. Even though revenue reached $18.7 billion, investors focused on what lies ahead rather than what just happened. That warning rippled straight across to India, with companies like Infosys, TCS, Wipro, HCL Tech, and Tech Mahindra heavily dependent on global technology budgets. Investors hit the sell button first and asked questions later. The Nifty IT index slumped more than 6%, making it one of the market's biggest casualties of the day. Elon Musk's SpaceX is on the verge of becoming more valuable than Amazon, with its estimated market value soaring to around $2.8 trillion. That's roughly $100 billion more than Amazon, making SpaceX the likely fifth most valuable company in the world. What's remarkable is that this isn't a traditional public company selling phones, software, or online shopping. Investors are assigning trillion-dollar value to a business built around rockets, satellites, space infra, and increasingly AI. The market's message is clear. Delivering packages in 2 days is impressive, but apparently delivering payloads into orbit is worth even more. Fund managers have found their favorite table at the casino, and it's semiconductors. According to the latest Bank of America survey, 80% of global fund managers now say that being long semiconductor stocks is the most crowded trade in the market. That's the second highest reading on record, topped only by the tech frenzy of 2020. What's striking is that the once dominant Magnificent 7 trade has fallen far behind, with just 12% calling it the most crowded position. The spotlight has shifted from big tech broadly to the companies supplying the AI gold rush. Crowded trades can keep working for a while, but history suggests that they leave very little room for disappointment. When everyone's on the same side of the boat, investors start paying close attention to the waves. Governments around the world are borrowing like the bill just arrived. Global sovereign bond issuance through bank-led deals has surged to a record $504 billion in the first half of 2026, surpassing even the pandemic-era borrowing spree of 2020. Italy has led the charge with roughly $81 billion raised so far this year, while countries including the UK, Belgium, and Serbia have all printed record-sized bond deals. And remember, this figure doesn't even include US Treasury issuance. Markets aren't panicking yet, but the message is clear. Governments are finding it harder to live within their means. As debt piles grow, investors will be watching closely to see who can keep servicing the tap without choking growth. India's stock market has one of the world's most fascinating duopolies. BSE has the breadth with nearly 6,000 listed companies, while NSE has the depth, handling over 1 lakh crores of daily cash market turnover. The surprising part, both sit on almost the same listed market capitalization, around 411 trillion rupees. Think of it this way, companies prefer BSE when they want a listing certificate on the wall, but traders prefer NSE when they actually want to trade. That's why NSE generates more than 3 times the revenue and profits, despite having half the listed companies. In markets, traffic often matters more than the real estate. Having more shops is nice, having more customers is better. For years, investors had a choice: chase expensive stocks or expensive houses. Now apparently they've decided to buy both. US stock market value has climbed to roughly 250% of GDP, while housing sits at 146% of GDP. The first time in modern history, both asset classes have simultaneously approached record valuations. Back in 2000, it was a dot-com boom. In 2006, it was housing. In 2026, it's a 2-for-1 special. Years of ultra-low interest rates, massive fiscal spending, and abundant liquidity have pushed money into almost every corner of the asset universe. None of this guarantees an immediate correction. But when both stocks and homes are priced for perfection, markets become a little less forgiving of imperfection.